Today we're going to be talking about bear call vertical spreads. The first thing to point out is that this is bear, which means it's planning on going down. And that would seem strange because calls are typically going up. So to understand this, you have to understand that it's a two-part strategy. It involves selling call options, and that's the bearish part. When you sell something, you collect an upfront premium, which that creates credit. Then at the same time, you purchase a second call option with the same expiration date, but a higher strike price. And here's what it would look like. You would sell, and that's red because you're selling, one contract of a stock, XYZ, at a strike price of $100. And again, you're selling calls. Because you sold them, that means you collect the premium of $3.30. And this might be called leg one. Then leg two, or the protection side of the trade, you would buy one, making it the same amount of whatever you sold, because this is protection, it's covering you, of the same stock at a higher strike price. Now, like normal, you would buy a call in case price went up. This would cover you, protection. And like if you were going to buy a single call, that would cost you something. So this side of the trade, leg two, is going to be negative $1.50. You add these two together and you get a net credit of $1.80. Now to the good stuff, max profit is limited to the net premium that you received, and they'll take out for commissions. The way to receive maximum profit is when the stock price closes at or below the strike price of the short call, which in this case, the lower strike price is $100. Then at expiration, both will be worthless, and this will all be yours. Now understanding the maximum risk, and that's figured out by the difference between the two strike prices minus the credit that is received. So the difference between these two strike prices is $5. The credit received is $1.80. So $5 is the difference between the two strike prices minus the amount of credit you received, which is $1.80, means potentially there's $3.20 at risk. We're going to show you how to change that. And here's the table for that. And if you see, starting right here would be about $90, $95, $100, $105. If we're buying this call spread here and we expect it to go down, it says we'll collect the full amount of our credit, $1.80. You'll realize most of that gain once price gets down to about $100. The rest of this is time decay, guaranteeing you price as long as it stays below for the full time. On this other side of this, if you see that price goes up to 105, 110, you start to lose money, which was the mass risk around $3.20. Again, we'll show you how to change that. Here's a chart I like a little better because it kind of clarifies exactly what will happen as price moves. So say that price is currently in between these two, and how do we know what our break even is? Which is pretty easy. You first take the short call that you sold, the lower strike price. In this example, it was leg one, sell the one XYZ $100 calls. Put the amount there. Next is take the net premium received, which is the net credit of $1.80. Add it to that $100, and it gives you $101.80. That's why in this diagram, you saw it right here at about 102. And right here, we're going between the 101s and the 102s, figuring that break even would be right in between these two. You can tell that because this is kind of ground zero for price. Either if it goes above here, you're going to be losing 20 cents. And if it stays below, bear call spread, you'll make 80 cents. And as the stock price or strike price goes up from here or down will depend on if you're losing money or making money. And that's why I like this chart better. It's easier to read. So as price goes up, you start to lose more. As you can see here, every dollar that it goes up, you start losing $1 in value. And you see if price goes above this, you're limited in your loss, $3.20, max loss. Now that's the risk of this. We're doing bear call spreads. So as price goes down in value, because we're up against resistance, in this scenario, you see that we gain $1 every strike price that goes down $1. And did you notice right here how quick that happened? We're already in our profits. It doesn't matter how far it goes down, we are limited in the profit that we'll make to $1.80. Now, when doing option strategy, the appropriate forecast is important. Understanding how a bear call operates will help understand why we're using this strategy. To get the maximum profit, we need price of the stock to be below the strike price of the short call, which is the lower strike price. So when we're looking at the charts, we'll see that this is kind of a neutral to bearish price action, meaning it gives us a high probability because we collect the premium and limit risk at the same time. Bear call spreads profit from both time decay and falling stock prices. Plus, we're selling implied volatility, which is the measure of how much a stock price fluctuates in percentages in a certain amount of time. Volatility is a factor in option prices. As volatility rises, option price tend to rise also. The impact of time decay, the value portion of the option, total price decreases as expiration approaches. That means you collect that money. This is known as time erosion. As the stock price is close to or below the strike of the call sold, then the price of the bear call spread decreases. That's good because it's making money. We want it to go to zero with the passing of time. This happens because the short call that we sold closest to the money erodes faster than the long call, which is why we like these trades. It gives us a good break even, so even if price goes up a little bit, we make money. Even if it goes sideways, we make money. Even if it goes in the direction we want, we make money. We sell the high volatility, so when it goes down, we make money. We sell time decay, so as it goes down, we make money. And that's why they call bear call vertical spreads high probability. Because when we see price coming into that resistance, we know there's going to be a sell-off. And we're able to put a bear call spread in right up against that resistance. So as price sells off, it's literally a guarantee of money. Price sells off, money. Price sells off, money, and that's why they call this high probability. Obviously, there might be some trades like this that looks like it's coming into resistance. We put a bear call spread on. We're happy until we're not. So we double down our bear call spread, and because we're doubling down, that means this trade wins, which makes up for the loss or maybe the break even. Because we're only needing price to stay under here, even if it shoots back up and retests, there's nothing to do but wait till expiration. You'll find out more times than not, even if price didn't get you out there, it went below the break even again. If it didn't get you out there, it went below the break even again. If it didn't get you out there, it stayed under the break even. If it didn't get you out there, it would have got you out here. High probability trades.